Good morning, everyone. So glad that you can join us today. Munzer Gaucher here with you with the Entrust Group with my special guest, Brian Buckhagen, President and Founding Principal of Pendo Investments. Today's webinar is Investing Your IRA and 401k in Multifamily Apartments and Buildings. We'll be discussing, among other things, the benefits of using a self-directed IRA to invest in real estate. Brian will share with you the pros and cons of investing in real estate, in particular commercial multifamily properties. We'll divide this webinar into three parts. Brian will first share with you his insights on the commercial real estate market. I will then provide you with a quick overview about the Entrust Group, who we are, what we do, talk about self-directed retirement plans, touch up on prohibited transactions, disqualified persons, etc. We will then set aside 10 to 15 minutes for a Q&A session where Brian and I will be taking your questions. I'm sure you're all anxious to hear what Brian has to say. Before we do that, I'd like to read this disclaimer for you. The Entrust Group does not provide investment advice or endorse any products. All information and materials are for educational purposes. All parties are encouraged to consult with their attorneys, accountants, financial advisors before entering into any type of investment. Okay, so Brian, good morning.
Good morning. Thank you.
Thanks for joining us, and it's all yours. Go ahead.
Well, thank you. So I'm going to take about 20 to 25 minutes and give everyone on the line an education in our view of the real estate world today, and in particular multifamily investing. Before I begin, I'll give you a little background on myself and my firm. I'm the president of Pendo Investments, and my goal today would be to educate, inform, and share some of our focused area of expertise about value investing in real estate with everyone on the call. At the end, as Munzer said, we're going to have a time for questions. Interactive is better, so save them for the end, and we'll try and address them all. Myself, I've spent 25 years in institutional real estate investing. I have a $5 billion track record where I was responsible for both acquisitions and asset management. I've been through many market cycles and had the opportunity to face those challenges. Our funds made money in those different market cycles. And I think that's because we have a discipline-tested and defensive approach to real estate investing, which is really focused on a value strategy. Value to me, so everyone knows as we go through this presentation, means finding properties that are underperforming the current market. That said, I'm going to move on to the presentation. Of course, as Munzer said, this is an educational webinar, so I'll go ahead and skip the disclaimers. What we plan to teach you today. First, my idea of real estate investing is to find and buy underperforming apartment buildings in select markets with attractive characteristics. Quite simply, that means to me that you find buildings that are underperforming their next door neighbor, the worst house on the block strategy. It's certainly no secret, but it's easier said than done. You try to find buildings that where the owners lack capital, expertise, and motivation, and find those acquisitions and then acquire them. Typically, we do see that they just aren't really capable. There's a lot of mom and pop owners out there. Most of private real estate and most of the apartment business is relatively small. Therefore, it's under the radar screen of institutions, which makes it inefficient and makes our business more able to capitalize on those inefficiencies. For Pendo, we like to renovate properties after purchase and raise rents to current market. What I would say here is that the most important phrase in there is current market. As you look at real estate investing, people often make market growth decisions if it were a stock strategy, i.e., they look at Denver and they say Denver's been underperforming and been down for 7 years, it must bounce back. That is a strategy. That is not my strategy. I like to find buildings that are underperforming the current market. Therefore, if they regress to the mean and capture current market rents, you make money. And if the market gets better, you do better. But you're not dependent on market growth. I think real estate should be in your portfolio for three basic reasons. One, diversification from stock and bonds. And I'll touch on this later, but private real estate has almost a zero correlation to the stock market and to the fixed income market. Secondly, real estate provides an excellent inflation hedge. I think most people would say that commodities and real estate are the two best inflation hedges. Although within real estate, remember that real estate that is occupied by tenants on long-term leases does not provide a good inflation hedge, i.e. an office building or an industrial building with a long-term tenant. And that's because you can't capture the rent increases because you're subject to a long-term lease. However, hospitality and multifamily price every day and every month respectively, and therefore provide an excellent inflation hedge. And I think the third reason you should have real estate in your portfolio is because of cash flow. So this phrase here, when we talk about the best of dividend and value, we are able to buy today assets that pay a 6 to 8% current dividend from existing cash flow, meaning before we add value, the assets themselves at acquisition are generating sufficient cash flow to pay 6 to 8%. And then after that, as you raise rents to market levels, you not only increase cash flow, but you create value. I'm often asked what I would look for in a real estate investment manager or even a private equity manager. As I mentioned, I spent 25 years running private real estate funds for investment banks. And here's what I'd look for in a manager. Co-investment. You want to make sure that whoever you're investing with has their money where their mouth is. I know it sounds simple, but and we've been through a lot of scandal and controversy and blow-ups over the years, but people often miss that. Make sure that your manager is putting their money where their mouth is and they have an alignment of interest with you. The second thing I would say is track record. Make sure you look at their track record. Is the fund or acquisition opportunity focused in an area where they've had success before, or are they shifting gears and trying to do something different? Look at if they've been able to retain their investors. When you have recidivist investors, that's always a good thing. You want to make sure people keep their investors. I'd look at their fiduciary culture, make sure they can be able to demonstrate to you that they have a track record representing investors' interests, keeping it simple with respect to their fund structure to make sure that there's no room for monkey business. And look at not only their time in business, but the number of deals. I often tell people that just because you've been in the real estate business for 20 years doesn't mean that you're an expert. I think you want to have both a track record of time and also the number of transactions. You want to see a lot of transactions because that's where you figure out all the things that can go wrong. And lastly, you want to see transparency in reporting. You want to make sure that you're being contacted on a regular basis regarding the asset's performance and that you have access to information that is thorough and informative. Why to consider apartments in your portfolio? I mentioned this on the previous slide, diversification from stocks and bonds. And you don't have to face that daily value fluctuation when you're staring at the CNBC screen of things going up and down. Obviously, real estate is more illiquid than a stock, but you don't have to face that daily value fluctuation. Typically, you're going to find real estate more predictable, current returns, and I think most of us know that while there are dips in real estate cycles, if you look back at a 40, 50-year trend on real estate, it's typically been up. So if you can afford the time period and make sure that you have the liquidity to survive the bumps and don't over-leverage yourself, real estate's been an excellent asset class. I mentioned before, real estate's a great inflation hedge, particularly in multifamily and hospitality, where you can capture inflation by increasing rents on tenants. One of the best reasons to like multifamily from my perspective is Maslow's hierarchy of needs. Everybody does need a place to live. It is true that in down markets you will find households consolidating, children moving in with their parents, so on and so forth. But people tend to pay their rent first, and that's important and part of what makes multifamily real estate a good investment. In terms of the market today, we've definitely hit the bottom with respect to multifamily, and we've bounced off of it. And I think we've bounced off of it fairly significantly. We definitely have all the empirical data to support an early recovery, and we in our portfolio are starting to see increasing rents and occupancy levels returning back to 95%, which is typically where you want to see multifamily real estate, 95% and above. I think it's always important in real estate to try to source transactions that are proprietary in nature, deals that other people don't see. I think there's two ways to do that. One is to have an expertise of a particular property type or area or location and know that you see value where others don't because you are an expert in the area. And the other and more consistent way to do it is look at your manager's time in the business and make sure that they have access to a proprietary deal sourcing network. Most people tell you in real estate that you need to buy it right. I would tell you you not only need to buy it right, but you need to asset manage it very well. And I think that's what people often forget. It's the execution of the business plan after a good acquisition. And another reason to consider real estate in your portfolio is the tax advantages. I think this is missed by a lot of people. Real estate is one of those last great tax advantaged investments, and that is because you get the benefit of depreciation, which means that your net operating income is reduced by the depreciation of the asset, typically in a 25 to 30-year cycle. So you write off the acquisition cost over a 25 to 30-year period and subtract it from your current cash flow, therefore deferring tax obligations and also converting ordinary income to capital gains income. Also, if you're going to renovate a property, as Pendo does, you get to both capitalize and depreciate that renovation cost and also expense in current periods some of that renovation cost. Therefore, we often see that in the first 2 to 3 years of acquisition of a property that we renovate, while we're able to distribute 6 to 8% current dividends from the property's cash flow, investors are not paying any taxes during that period. I think you have 4 basic investment choices: stocks, bonds, cash, and real estate. In today's market, and I'm not sure how long it'll last, I would guess 12 to 24 months with a great buying opportunity and a real estate cycle that's probably 5 years from today. We have seen compressed real estate cycles since the early 1990s, 7 to 9 year periods of up to down. But in today's market, what I hear from most investors and what I believe are stocks have been extremely volatile and not as much upside as we've seen in the past in a tough world economy, and they're influenced by many things outside of our control and outside of the domestic USA. Bonds have low to no current yield, and so what you've seen with many state pension plans and large investors is that they've had to shift their allocations and increase the real estate allocation because there just is no yield from bonds. Same thing with cash, no real return, no inflation hedge. So when you look at those 3 basic asset classes, you just can't get any yield. Real estate provides good current yield today. There's amazing debt available. As we all know, interest rates are at historic lows. So with the current cash flow of most real estate and low debt pricing, you're able to really maximize yield. Those are the keys for real estate right now. I'd also mention that money flows, the flows into certain assets, money flows have been out of real estate 4 of the past 5 years, and I think you're starting to see the smart money flow into real estate in a big way these days. The current real estate market, I'd say across the country, and this may be dated by 6 months or so, but across the country I'd say the real estate's 20 to 40% off its peak values. Many sellers still remain in distress. The reason for that is they were over leveraged, they bought at the wrong time, and they're not quite sure how to get out of their situation. That's provided a lot of opportunity across the country. I mentioned low rate financing, obviously a driving force and a real yield booster. If you're able to buy properties at 7% unleveraged returns and layer on debt at 3.5%, you can see how your current yields are going to be significantly enhanced. You're still able to buy below replacement cost. I think a lot of people forget that. In California, for example, there's almost no new supply of multifamily real estate. There's a number of reasons for that, and this is similar across the country. One is cities like things like car dealerships and retail centers that generate tax revenues. Multifamily is a user of city services and doesn't add a lot to the city's revenues. So therefore, despite the rhetoric that people want affordable housing and they want more housing in their communities, the reality of it is cities would prefer things that are tax generators, not tax users. Also, the current rental rate market just simply does not justify new construction of multifamily. And of course, when you look at its supply and demand, that's key. I will tell you, if you look back to the 1960s and real estate cycles, every time we've had a hiccup, a recession or a depression in real estate, whatever we want to call it, it's always been supply side driven, i.e. we overbuilt and the market went into a depression, recession, whatever we'd like to say. The demand growth for real estate has consistently been positive. So we've always had demand growth for new real estate, and when we caused a problem for ourselves, it was supply side driven. Today we're not seeing that. The ubiquity of information and the transparency of information available to real estate owners and operators and banks that lend on new construction is much better. We know when people are going to build new supply and it's available to the market. It simply was not that way 20 years ago. We also have seen the elimination, for example, in California of the redevelopment agency. So a lot of the multifamily product that has been built across the country has been funded by the taxpayers, by you and I, and did not make sense at a market rate basis, but did make sense if it was subsidized. In California, for example, with the elimination of redevelopment agencies, we're just not going to see much new construction at all unless rents are to increase 30 to 40% where they are from where they are today. So that's a real positive thing to look at, and you'll see that in different places across the country. Also, multifamily is benefiting from demographic trends, and that's why you've been reading about this in the papers, probably say for the past year or so. When you look at the typical renter profile, which is 20 to 34-year-old people, look at the bottom chart here. The population growth is enormous. So the biggest renter segment in the country is increasing significantly over the next 5 years. And you can see that in the chart that's titled Apartment Rent and Vacancy Trends. This is the empirical data I spoke about. You can see that in 2008, vacancy peaked in the country in the past 10-year period, and we are definitely seeing a decreasing vacancy rate, and you are seeing increasing rental rates. So the blue bar graph is rental rate, which is going off, and the gray line is vacancy rate. So in 2008, 2009, vacancy peaked. It's fallen significantly since then, from 9 to I'd say 5%, and probably will be reported at 4% this year on average across the country. And rental rates have been increasing substantially. This chart I stole from Morgan Stanley. I will send this presentation to all of the participants after the call. I'm not going to go through it right now, but these are the reasons. You're seeing the rent versus own decision being made in a very different way than it was 5 years ago, and it's very compelling for multifamily investors. The only thing I have to say about this chart on current market opportunity is I am many years past the 20 to 34-year-old demographic, so that always makes me sad. However, when you look at this with respect to multifamily investment, you can clearly see that the job growth, not only the demographic trends are supporting multifamily investing, but the job growth is primarily in the category of people that rent. And this is very important. In the 2009 tough times, the renter demographic lost fewer jobs, and as the economy has recovered in 2010, 2011, and I'm sure we'll see it in 2012, most of the job gains, in fact 70% of the job gains, have been in the renter demographic. Here's some background and facts on apartment investing. As I just mentioned, we're starting to see delayed home ownership, shifting views on the value of home ownership, demographic trends that are supporting apartments, and we're regressing to our kind of 25-year historical average of own versus rent in this country. The population's still growing, and that's the demand growth I spoke about with respect to real estate cycles. And it's very hard to get a home loan today in this market, even for the the best borrower in the country. It's still hard to get a home loan. And so that's really changed significantly from 2007 to today. I mentioned before, everyone needs a place to live. We've definitely seen more demand growth than supply growth, as mentioned here, on rebounding off the bottom. And there's a lot of facts to support that. Rental rate increases are almost 5% predicted across the country on average. That is very significant. If you look at that, especially compared to what you get paid in your checking account today in terms of interest rates, that's almost 450 basis points that you're going to do better than inflation today. And so that rental rate increase across the country is going to be significant to returns. If you go back and you look at all the basic food groups in real estate, and by basic food groups I mean office, industrial, hospitality, and multifamily, historically apartments have been the best performing asset class. There's a lot of reasons for that. I've mentioned many of them. One of the reasons I haven't mentioned so far is that the cost to put a new tenant into multifamily and the cost, as we say, to turn a unit for a new person is significantly less than an office building where the tenant requires tenant improvements to their specifications. And so that has contributed to the fact that multifamily, in addition to all the other reasons, multifamily has been the best performer within the real estate asset classes. I think if you're going to be a buyer of real estate, you want to be a disciplined underwriter. Everybody says that, but I say most forget about that. You really want to do it from a bottoms-up basis. You want to make sure you understand what drives real estate rental income. And as I like to tell our managers at properties, it's a very simple business. Lease space and collect rent. And if you do those two things well, you're going to make money. And to lease space, you have to make sure that you have demand drivers. You want to be around areas of employment. You want it to be diversified employers. You want to make sure the trend is your friend and you're going into markets that aren't getting worse, that are at least stable to getting better. The way I've done that historically is smile investing, as I like to call it. That means if you drew a smiley face from Seattle to the Mid-Atlantic, you want to be south of that, where there's population growth and job growth. Because with population and job growth, even if you buy at the wrong time in a market cycle, you're still going to have a chance to be right because demand is going to be increasing. You also want to look at what's going on with home trends because clearly there could become a time with increasing rental rates that homes become more affordable or people are paying as much in rent as they would for a home. You want to avoid those situations because that would be bad for multifamily in particular. You want to look at crime rates. It's available on the internet. Call the local police. Understand what's going on at your property. You personally want to shop all of the competitive properties. You want to walk in them. You want to see them. You want to understand their amenities. Do they have washer-dryer hookups? Do they have a pool? How's the on-site manager? All these things are going to tell you how your property competes. You're going to want to look at the tenant profile. and you're really going to want to pay attention to that neighborhood. And then when it comes to underwriting, from my perspective, I mentioned it several times already, regression to the mean. You want to make sure that you are getting your fair share of current market, and that when you buy an asset, and if you're going to add value to that asset, that you can get the current market rental rate today and regress to the mean. That is a very defensive way to invest in real estate and protect yourself in different market cycles. When I look at a market, I've already mentioned this, positive population, demographic, and employment trends. Very simple, no secrets there. No one-horse towns. Put yourself in growth areas. You want to make sure there's barriers to future supply. Those are both economic and physical. While I'm not a big believer in investing in Las Vegas because it's a very high beta market, you certainly can make money there, and I have. But one of the things that people often miss about Vegas is they think there's unlimited supply growth. There's really not, because the government lands around Vegas form natural barriers. So there are some counterintuitive things in some markets with respect to finding infill locations and barriers to future supply. Mostly across the country today, the barrier to future supply is going to be economics, that it just simply doesn't make sense to build new multifamily. And then in major urban markets, it's going to be not only economics, but there's very little available land, and you're going to get fight back from cities on things that are government tax using versus tax accretive. I like to be close to ports, distribution, and transportation centers. Where I live in Los Angeles, the ports of Long Beach and Los Angeles supply most of the goods to the East Coast, unbelievably, and those ports are doubling in capacity over the next 5 years. So that's a huge job generator and a very important thing to consider. I love research facilities, universities, and state capitals. Those are also good places to invest. And when you go look at a multifamily property, put yourselves in the shoes of a tenant. I want to make sure I'm close to grocery stores, schools. Can you walk to a school? That's a big deal. Parks and public transportation. Because a lot of the demographic profile that I see, often it's a one-car family, and those convenient walking close amenities are very important. I think when you look at a manager of real estate, if you were to invest with a manager in real estate, I mentioned a couple of these before, what I would look for. One is a significant sponsor co-investment. Make sure they put their money where their mouth is alongside other investors. Make sure that the manager's compensation schedule is based on profits and not on fees. Make sure that they're hands-on managers, that they're really going to be at the properties. They're not delegating the asset management of the investment to third parties who don't get paid very much. Make sure they're going to be hands-on and have direct oversight of things. And make sure that they demonstrate to you that they have excellent reporting, transparency of reporting, and those types of things. We've even implemented an online reporting system, much like you would get from your Charles Schwab account, where people can access information about their real estate investment. Those kinds of things to me are very important, especially in today's market. I'm going to close with this and hand the microphone off to Munzer. This was a recent transaction. We buy very large buildings and sometimes very small buildings. This was a very small building. We bought this building December 30th of 2010. And in the first 9 months, we were able to increase the income 40%. Why? The seller was very distressed, was losing the building. They had over-leveraged it during the market up cycles and siphoning off cash. They couldn't hold on to the building, so we were able to buy it in a distressed sale. They didn't renovate the building because they were taking cash from the asset, not contributing cash. So we were able to do a significant renovation to this building, increase market rent substantially, get better tenants who stay longer, and lower our future operating costs with the renovation, and create significant value for our investors and for ourselves. This can be done across the country. Private real estate is very disintermediated and very inefficient and still in the hands of individuals as opposed to institutions, and larger real estate deals that are simply quite efficient across the country. And so this is the area that we like to focus on, and I would encourage you all to focus on. So with that, I'm going to hand it over to Munzer. Thank you for your time, and we'll try and save some time for questions and answers at the end.
Great. Thank you, Brian. Great stuff. Very informative. I'm sure our listeners out there are going to have some questions for you that we'll, as you mentioned, get to after my quick presentation here. So again, Munzer Gaucher here with you with the Entrust Group. The topic I'll be covering today is Introduction to Self-Directed IRAs. And before I do that, for those of you that are unfamiliar with the Entrust Group, a little bit about who we are and what we do. We're the nation's premier provider for self-directed retirement plans. We work with individuals and small business owners who wish to take control of their own investment decisions. What makes us unique is that we only offer truly self-directed retirement plans. So we allow you to invest in all allowable assets, not just the securities, CDs, and mutual funds out there. We don't sell or promote any products. Entrust just provides education to you and administration for your plan. We've been in business for over 30 years with over 14,000 clients and nearly $2 billion in investor assets. But what really differentiates us from our competitors is the local offices that we have out there, which allow us to provide the necessary education and superior customer service to our clients out there. We currently have about 9 offices nationwide, including our corporate office up in the Bay Area, and we are growing. Throughout these local offices, we offer continued education programs to our professionals out there, such as attorneys, CPAs, realtors. We also have ongoing in-person seminars to introduce you, the public, to the self-directed IRA concept and educate you on how to start investing in non-traditional assets with your retirement plan. So speaking of non-traditional assets, by using Entrust as your retirement plan administrator, you get much more greater flexibility in the number of investment choices you have. You see, our clients invest in over 50 different investment choices, and they do get greater. There are only a couple of asset classes that the IRS deems not permissible. We will discuss shortly. Other than that, you may invest your IRA in just about anything. So here's a few of the more popular investment choices that we see our clients investing in. Obviously, by far, real estate is the largest asset class that we see clients investing in. And it comes in different forms, whether you're investing in single-family, multi-unit homes, apartments, condominiums, commercial property, as Brian was mentioning, developed or raw land. A lot of our clients just purchase a piece of raw land with their IRA and hold it to appreciate. And since you're buying this asset, namely a raw land, with your retirement plan, all the expenses are paid out of that. So in this case, it's just the property tax, so they find that very simple. Foreign properties, a lot of times we get calls, people thinking that they can only invest locally or nationwide, but the fact is you can invest your IRA in internationally offshore properties, as long as you are aware of the rules and regulations in the country that you're investing in. It's allowed. Trust deeds, which are notes secured by real estate. We see a lot of our clients investing in that. Leverage properties, a topic another day. But basically, you can use your IRA as a down payment, and the IRA itself applies for a loan, and you can purchase a property that way. Precious metals, very, very popular. Clients investing in limited liability companies, limited partnerships, doing secured, unsecured loans to non-disqualified persons that we'll discuss in a bit, and other unique investments such as life settlements and others. Just a few choices of what you may invest in a self-directed retirement plan. So here's what the IRS specifically states in the IRS Code 4975 as the investment restrictions. Things that your IRA may not invest in. Very few, as you can see. Collectibles, can't invest in any work of art, any rugs, antiques, any stamps, any metals, with some exceptions, such as gold, silver, platinum, palladium, bullions. Life insurance policies, you may not. S-corps, because the tax law prohibits IRAs to invest in them. So this is it. I mean, even though the list is small, there are certain transactions that you want to be aware of as opposed to investments that are prohibited. We'll touch on a few of them after we talk about disqualified persons, because I think in order to determine whether a prohibited transaction is prohibited, it's better to understand who is considered a disqualified person. That is, persons that cannot do business with your IRA. Again, the IRS states certain family members, and we want to think of them as people that are directly related to you as up or down, direct ascendants or descendants. For instance, grandparents, parents, children, grandchildren. These the IRS deem as disqualified individuals and therefore cannot transact with your IRA. So in short, a prohibited transaction occurs when your IRA engages in a deal with any of those disqualified persons. So some example, for instance, of a prohibited transaction, and probably the most popular one that we almost on a daily basis have this question is can my IRA buy a property that I already own and someone of those disqualified persons own? And obviously the answer is no. So buying, selling between your IRA and a disqualified person is prohibited. Another example of a prohibited transaction is providing goods and services. So for instance, you're looking to purchase a piece of property with your IRA, and you are in the property management business. You cannot manage this property. You need to find a third party that will do so. It's not required to have a property manager, but if you are going to have one, it has to be a third party. Same thing as if you're looking to rehab the property. If you are a contractor or if your father is, then obviously you cannot have yourself or your father do any rehabbing to that property. Another example, again, would be the use of the property, whether it's a vacation or renting it or living in it, that you cannot do that. You want to make sure that no self-dealing and no personal use. So the general rule here is if you're buying a piece of property from a third party, renting it to a third party, and then eventually selling it to a third party, you have no issues here. Again, the IRS imposes severe penalties for a prohibited transaction, and basically they deem the IRA as treated as a distribution, and you pay the applicable taxes and penalties for that. Again, for more information on that, I encourage you to read up on IRS Code 4975, which really talks about prohibited transactions and disqualified persons in detail, more details. So we talked about disqualified persons. Here's some examples of acceptable transactions, things that you can do. One of them would be partnering with yourself on a new deal. Well, one of the strategies to purchase a property that we see is people partnering with others. For example, on a larger deal. For example, if they want to purchase an apartment building, a commercial property, what have you. Now, I know we talked about disqualified persons being yourself, but the key word here is a new deal. So if you may partner with yourself and your IRA as two separate entities to go in together to purchase a property as long as that property you're purchasing is from a third party. So that is acceptable as long as you're doing it on a new deal. Partnering with your cousin, well, obviously a cousin is not considered a disqualified person because they're not of lineal ascendants or descendants to you. The spouse is considered disqualified as well. So again, partnering with the spouse would have to be on a new deal. So what we see a lot of times is couples come to us and to invest in a large deal, and they would have three investors, if you will. It would be his IRA, her IRA, and their personal monies going in together as undivided interest joint tenants to purchase a property, one way that you can look into it. Another acceptable transaction is leasing the properties to siblings. As you notice, the list of disqualified persons that we've discussed briefly does not include siblings. The brothers and sisters are okay in the IRS world as long as you're working with them as if they are third parties. That's the thing you want to be aware of, renting to them at fair market value and selling to them and buying from them at fair market value as well. Plan types. We're not here to discuss the different plan types. We have specific webinars, and we go into that in greater details in some of our in-person seminars. But all I want you to be aware of here is that all types of IRAs and qualified funds can be self-directed. Very simple. So if you have a traditional IRA at a bank, you move it over to Entrust, now it becomes self-directed. You have a Roth IRA at a brokerage firm, you move it over to Entrust, it becomes a Roth self-directed IRA. It's that simple. Funds from qualified plans, including a 401k, 403b, 457s, we got a lot of questions on those. And in summary, in short, if you have a previous employer, 401k from a previous employer, that for sure could be rolled over into an Entrust IRA account. Chances are, if you're still currently employed, your current administrator will not allow you to move that over. But obviously, take it case by case and maybe ask him and see if you have any vesting provisions in there that allows you to move it over. But for the most part, any IRA, obviously you can transfer. Any 401k from a previous employer, you can roll over. Okay, so 3 easy steps here we'll talk about to what it takes to set up an account with Entrust and fund your investment. So step 1 would be to open up an Entrust account. That normally takes about 24 to 48 hours. Very simple paperwork that you would complete, and we get the account open for you. The second step would be funding your account, and there's really three ways that you could do that. One would be to obviously do your contribution for the year. 2 would be to do a trustee-to-trustee IRA transfer. 3 would be to do a rollover from a previous 401k. The thing you want to be aware of when you do this is the time frame involved in doing this. Many times, especially on a real estate transaction, we have clients or prospects calling us with an investment in mind already, and they're looking to go ahead and purchase a property, but the account is not open yet. Want to keep in mind that normally it takes about 2 to 3 weeks to move money over from one trustee to another. So the best thing to do is get your account open, let us work on funding it for you, and then go out there, purchase the asset. Obviously, let us purchase the asset for you, identify the investment. So let's say in the case of a real estate investment and the account is already opened and funded, the steps would be to get a purchase agreement in the name of the IRA, because that's who's buying the property. Earnest deposit will be paid out of your retirement account. All escrow papers will come back in the name of your retirement account. We sign on those as your trustee. We fund escrow, we close escrow, and now your IRA owns the property. It's really that simple. All expenses will be paid out of the IRA. That's what we do for you, and then all income generated from that property goes back into the retirement plan, tax-free or tax-deferred, depending on what type of retirement plan you have. Obviously, we have a very experienced real estate department that will hold your hands in the transaction and coordinate with escrow departments for you to make sure that everything is done smoothly for you. Okay, so if you want to learn more, obviously there's one thing that I'd like you to do is take advantage of the local offices that we have wherever you are at and you have a local office close to you, call us, stop by. Love to meet with you in person and discuss more about the investment options within your self-directed retirement plan. Sign up for, again, one of our in-house seminars that we have. Visit our website, a very educational website that we have, wealth of information in it. And that's it as far as my part of the webinar. I want to see if we have any questions out there from any of our attendees out there. I don't see any. Brian, do you? Brian? Okay. Well, once again, I want to thank all of you for joining us today. I hope that you found the material informative and educational. I hope that you feel empowered now to go out there and learn more about investing in non-traditional assets with your retirement plan. I want to, again, thank Brian Buckhagen of Pendo Investments for joining us today. If you have any questions about self-directed IRAs, please feel free to give me a call at 310-899-3811 or email me at mgosheh@thentrustgroup.com. That's mgosheh@thentrustgroup.com. Thank you again for joining us. Have a great day.
Thank you.
Thank you. Please stand by.